Craig, thank you so much for joining us today.
Elijah, my old friend, it's always nice to sit down and visit with you. Thanks for reaching out.
Well, it's great to have you today. I did want to get your take on the markets. First and foremost, with gold and silver, it seems like rallying again here. We're recording this on May 22nd. We had a pretty good rally yesterday. And also, it seems like the stock market may be falling again, with all the debt issues and all of that. So your perspective on the state of the markets right now?
Well, let's start by, gold is not just a dot on a screen, right? I think a lot of folks, when I read Twitter, or even just see people on my site, sometimes get confused with the futures price, which is just, a price like anything else. It's just a dot on a screen traded by algos, but yet it's a physical commodity. And that physical commodity is what backs up all those futures contracts. And we had a note, and it's not like you could say it's not like the head of the ECB came out, in a press conference and said, oh, we got to be careful about the counterparty risk, in all these gold derivatives in London and New York. So it's not that, but a team of economists at the ECB put out a note back on Monday, officially on the ECB website, that said a lot of the stuff that you and I have been talking about for a decade, Elijah, about, the leverage that's applied within the futures markets and the forward markets, where 1 ounce gets hypothecated and rehypothecated, and you don't know how many physical ounces back up, or how many contracts there are, or how many digital ounces there are versus each physical ounce. And that's what the ECB economists were warning about. And so when you look at gold just as a dot on a screen, and you go, well, it's, every time it's been this far above the 200-day moving average, it eventually pulls back, and you start talking about, some arbitrary price of, 2,800. It's almost like some of these folks try to talk that into existence. The chart shows a fundamentally sound market that just keeps moving higher, in a pattern of, kind of two steps higher, 1 step back. We pulled back last week in price to the 50-day moving average and held it for 3 days, which is exactly what happened in early April after the Trump's tariffs announcements. And so I think this notion that gold's going to swoon through the summer, and pull back, and it's, all the way back under 3,000 or something for people that are waiting to buy the dip. I don't think that's coming. I think the opposite's true. I think we're going to rally beginning as soon as the calendar flips. Heck, it looks like it's already started. And I think new all-time highs are coming sometime in the next 60 days.
Now, with respect to what the ECB stated, I know I was reading some interesting things they were saying about kind of investing in gold here, but you were saying actually that they reported that there could be more paper ounces than physical ounces there available.
Yeah, that's what they're alluding to, is that there's counterparty risk. And that counterparty, these big banks have this massive exposure against higher prices because of the way they manage their books, and that actually is a threat to the financial system. I mean, these are all things that, again, I'm like reading this going, is this guy a subscriber to my site? I mean, we've been talking about this for 10 years. And so we'll say just that, what it reminded me of, because gold, there are a lot of things that have been driving price higher this week, right? The downgrade of the U.S. debt late last Friday after the markets closed, spiking long-term global interest rates, this passage of this big, beautiful bill that doesn't have any deficit or debt reduction at all. People thought, austerity and, they're going to balance the budget and Doge and all that's out the window. Okay, and so there's a realization now that's building that all that is out the window. And that's what the bond market is seeing that. So there's a lot driving price this week. But when I saw that, and I've seen the rally since, it kind of reminded me, remember back in about Valentine's Day, Elijah, there's that article that appeared in the Financial Times about delivery delays in London. Remember that one? And we already kind of knew this was happening. There's this big wide spread between spot and futures, and metals going all over the place. And they're talking about it was related to tariffs allegedly. But when it got codified, if you will, in a mainstream source like the Financial Times, everyone, whoa! You caught like mainstream hedge funds and financial advisors and other mainstream sources kind of off guard. Like, wait a second, I had no idea. How is this happening? We didn't know this, but here it was, the Financial Times. And I kind of thought, in a similar sense, that's what that ECB note was. I mean, a lot of us, that follow gold intently and discuss it, and have for years, talk about that risk because it's a fractional reserve system. And the risk that if you just keep deleting the physical, what did China import last month officially? I mean, unofficially, because it's all mainly, through shades. It's not China's buying the PBOC. It's just everywhere. It's like 100 some odd tons. If you keep taking all this metal out from underneath the system, it forces a deleverage. And so anyway, like I said, I think that ECB note was just kind of a slap in the face, kind of like that article in Financial Times was. And that's kind of helped spark all part of what was driving gold higher this week.
Does this really confirm what a lot of, you've been talking about for so long about manipulation in the markets? Is this what the ECB is kind of alluding to? Is this actually precious metal manipulation, or is this different from any other commodities or what happens in any other commodities here?
It's pretty clear to me watching this stuff for 15 years, that there are hands that move price at certain points, both up and down. I mean, you can go back a couple years ago when the banks were actually getting net long in silver and it was the hedge funds that were short. And you can see these things because especially in silver where it's a tiny market. But I don't think in this case, I don't think that's what we're driving at, Elijah. It's just the structure. If you want to just paint it as normal business operations, we don't make directional bets, that the banks have, in their vaults, whether they hold it themselves in London or for somebody else, and then they hedge that, right? That's what everybody says, they hedge that on the futures market versus a physical position in London. At the end result of that, how many times have those same ounces in London been hedged and sold forward? Because again, the London tries to tell you they got all these tons, in their float, and what saved them back in March? Well, central banks coming in and leasing gold in the market. Well, then how many times has this happened in the past? And how many times have those ounces been released, and reloaned? And it's this kind of like not necessarily like a pyramid scheme or a Ponzi scheme. It's this fractional reserve. Okay, there's a certain amount, there's a certain float, there's a certain amount of ounces that backs up this whole pyramid of derivatives on top of it, futures contracts and forwards contracts. And as you shrink that supply, it just stretches the leverage even farther. And it's like remember when I wrote my macrocast this year, and we always do a call and talk about what was in there. And I always tell you, I write those for myself so I can go back at the end of the year and go, what did I get wrong? In 2024, I thought, well, gold will probably go to 2,300 or so, maybe 2,400, which was still going to be a good year, but it just kept going. And now it's continued to go this year. And I thought, what did I miss? I think the main thing I missed, and this is noted in that ECB piece from earlier this week, central bank demand and constantly being on the bid is depleting that Western supply that underpins that system. It's 34 or 3,500 cumulative tons of net demand from central banks in 22, 23, and 24. Well, unless they're leasing it back, and most of them aren't, then that's just metal that's just, shrinking that bottom part of the pyramid. And that's what the ECB is warning about, that eventually, that creates really a systemic risk to those banks. And they're urging other banks be paying attention to this so they don't get caught flat-footed if, within that, this counterparty daisy chain of all their different obligations, that there aren't stresses coming for the banking system there and here.